Hey guys, hello and welcome to this YouTube series. I'm Manisha Gupta and we have spotlight this time around on the US Fed tapering. Well, that word has been used in the past US Fed meeting and the markets have seen a knee-jerk reaction to that also. But the fact that it would not happen immediately, the US Fed will ensure that it prepares the market before it actually does it, is what has seen some consolidation come back. Well, the US Fed taper, or the word taper, was first used by the previous US Fed chair Ben Bernanke, and it has been on since then. Well, what does tapering mean to begin with? We do understand that when the markets were weak because of the pandemic restrictions, lockdowns, the global chains broke down, the consumption went down, there were concerns with production, etc. The economic data was down, the economies itself were shutting down, and that is the time that various global central banks came out with more printing of money. They pushed more money into the system to ensure that the economies would kickstart yet again. So this is called quantitative easing. Now, what does tapering mean? Tapering is that once it has had a desired impact, that all the money has had a desired impact, that money incrementally is started to see a reversal from the central banks. So it's a reduction at the rate at which central bank accumulates new assets on its balance sheet under the policy of quantitative easing. With the US Fed itself, we do understand that it is as of now doing nearly $120 billion of a bond buying on a monthly basis. So when you start looking at a tapering, they would perhaps cut this amount a bit as they move forward, and that is what is called tapering. And important is that various global central banks will keep an eye on the US Fed on what direction it moves and perhaps take cue from that, because from the US more than $8 trillion of quantitative easing or stimulus is what we've seen come in. So it's a record number ever that US Fed has put out, and the other global central banks, as I said, will take cues from that. So coming back to tapering, and it is going to be quite important on how the US Fed really looks at that. But what tapering really means is, and this really is the first step in the process of either winding down or completely withdrawing from a monetary stimulus program that has already been executed. The other important question is on why taper. One, because the QE policies or the quantitative easing policies have accomplished the desired effect of stimulating and stabilizing the economy. The other important point on why the banks should taper, or there is a need to taper, is that because if you continue to stimulate the economy with easy money, once the recession is over, then it would lead to out of control inflation, something that the global central banks have been talking about, and then monetary policy driven asset price bubble. We have seen various asset classes run up, whether it is equities, housing prices, commodity prices for that matter, and then that leads to an overheated economy. So once the task of this quantitative easing has been done, there is this need to withdraw this taper as well. What is a taper tantrum? Well, that's the next important subject, because every time you want to pull the money that is already in the system, you will see a knee-jerk reaction, you will see correction in various asset classes until they come to a level where there is fair, where there is sanity, where there is demand supply coming back into the markets, rather than easy money floating into the market that would keep the prices higher and take inflation much higher. So that is the requirement of a taper, and the taper tantrum is when you see these knee-jerk reactions coming into the market. Usually it is said that the taper is mostly on paper, because every time a bank tries to pull this money back, there's a lot of reaction from the markets, and you have to perhaps do it much lower than what you initially started to do. Does tapering affect asset classes? Well, it absolutely does. As I told you, the money that is into the system, when it is winded down, you will see that impact into the markets. We already have seen a knee-jerk reaction. So there would be some weakness in the US dollar that the markets are anticipating. You will see the speculative froth, or the froth created by this easy money into the markets, also go out. So there could be some correction that you would see happen in case of industrial metals, also in case of housing as a sector. In some senses, equities also, gold for that matter. Until the inflation is on, you will see the gold prices supported. But once much of this easy money goes out, you will see some correction come in for the gold prices also. So keep an eye on that. As of now, we do understand that the Fed tapering conversation will only begin in summer. Some part of it could perhaps start by the end of this year. But as has been said by the global central banks, that they will want to watch out for data, for inflation, for employment, and then only start conversations on this or on interest rates.